Uh, okay, so a lot of you guys might not be ready for what I'm about to talk about. In today's video, I'm going to be talking about what really moves the market, and I'm going to be dropping a little bit of a bomb here on the Forex trading community. Okay, are you ready for it? Here it comes. Price action, I'm going to use the acronym PA, is not king, okay, in my opinion. Have you ever heard the saying, price action, technical analysis is king to understanding how the markets move and how to make money in them? Well, in today's video, I am going to be the big, bad, evil person who says that that is not necessarily the case, at least in my opinion. Today, I'm going to be telling you a little bit about what truly moves the markets. And guess what? It's not just a pin bar. It's not just, a higher high and a higher low. There is more to it. And there is a lot that drives markets up and down. So if you stay tuned in this video, I know it's going to be a little bit on the longer side, but if you stay tuned, I'm going to talk to you about what really drives the foreign exchange up, down, sideways, what strengthens currencies, etc. So let's get into it. Okay, so when I say price action is king, the first thing I want to say before I get a bunch of people, I can already hear the keyboards typing right now. They're saying, Nick, you're stupid for saying that. Yes, it does rule the markets. I'm not going to say that price action is bad. Don't get me wrong. I use it myself. Price action is an important tool in the toolbox, but picture that technical analysis in general, this is a really ugly toolbox, but technical analysis is one of the tools in the toolbox, in my opinion. But there are other things or components that we can add to our toolbox to help to give us a better edge in trading Forex, okay? How do you define an edge? Is it just going to come from a pin bar? Is it going to come from a moving average crossover? Maybe you can get a little bit of an advantage from some of those things, but I feel that there are some things that we heavily have to talk about. So let's get into it. What are the other things? Well, the first thing I want to talk about is fundamental analysis. Believe it or not, the market is not moving up just because of, the candlestick patterns and price action that is going on. The truth is there are fundamental drivers in the foreign exchange market every single day. What are fundamental drivers? Well, I'll list a few now. Okay, when you're looking at a currency and you're trying to evaluate a currency, there are things that come into play. For example, if we are talking about the US dollar, we are talking about the US's obviously currency, and each of these major banks, major central banks, they offer a currency, right? You've got the Australian dollar, the New Zealand dollar, the Canadian dollar, the Japanese yen, etc. Each one of these can be broken out into a couple main factors that we're going to talk about. You have things like GDP growth. Okay, what is this, you might say? Well, GDP growth is the gross domestic product growth of an economy. Is there a growing amount of output from an economy? Is there a shrinking amount of a growth in an economy? Is it growing but slower than others? That's a huge question mark to what is actually driving the markets up or down in the currency market. Well, another factor is, of course, things like unemployment. Unemployment. I'm gonna do my best not to misspell anything. So unemployment is another huge thing. Why? Well, because you sort of have factors here that could lead into big price movements. If you have strong employment in an economy, it is likely good for GDP growth. It likely attributes more to the potential for an economy to grow at a more rapid pace. And ultimately, a rapidly growing economy tends to strengthen its currency. Why? Because investors from around the world want to actually buy something like the US dollar if it is looking strong in the area of GDP growth. Okay, so there are all these factors. These are fundamental factors that you're not going to hear a lot about on YouTube from your average trading guru who is just talking about, double tops and, head and shoulders. And well, all those things are fine. Don't get me wrong, but they're not the only thing. And they are certainly not the driving force in the markets. This stuff is the driving force in the markets. And in this video, like I said, I'm going to try and give you guys a surface level view as to what to be paying attention to, in my opinion, on the fundamental analysis standpoint to actually look to trade Forex successfully. So we've got GDP. We've talked about unemployment. The next one is a big one. Okay. It's going to be your interest rates. So remember how I just talked about for a second that we are thinking about foreign investors wanting to buy a currency? Well, one of the reasons that they might want to buy it is because of a country's interest rate. Now, interest rates are basically they're sort of like a dividend. If you're familiar with a stock, you know how a stock, sometimes stocks may offer a dividend. So that means that the investors that hold onto the stock can be compensated in the form of a dividend over time, right? Well, similar to that, currencies and central banks can offer a interest rate to their lenders. Well, a higher interest rate is usually viewed as bullish for an economy. Have you ever noticed the Fed meetings in the United States can cause some massive volatility like we've seen just recently on the US dollar? Well, one of the big reasons for that is because they are talking about policy that could lead to rate hikes, rate holdings, whatever they're thinking about can be discussed in those meetings, and it can have a massive impact on the future pricing of the US dollar, and any central bank discussing their currency can be impactful to the value there. So interest rates are a massive one. So like I said, generally things to remember are that rising interest rates or monetary policies that are quote unquote tightening are generally viewed as bullish for a currency. So let me say that again for maybe the newer traders that might sound like a lot. If you have a central bank that is looking to tighten policies, meaning that they are looking to offer less stimulus to an economy, what that tells us is that if an economy is able to stand alone without stimulus or help from a central bank, that tells us that that economy looks strong, right? If the bank is having to step in all the time, the central banks are having to step in, that implies that the economy needs help and that the economy is not as healthy. So rising interest rates basically say, hey, we're pretty confident in the economy, and we think that for the most part, we can step away from stimulus or helping that economy out. So raising interest rates is generally viewed as a very bullish or positive thing. And this is a huge driver in the currency market. When you have a central bank that is raising rates and looking to actively grow that, it can be incredibly bullish for the monetary power, for the value of that currency. In fact, monetary policy around the world at the time of making this video, after the pandemic, or at least hopefully after we've got that Delta strand potentially in sights of investors. But this idea here is that we have been, everyone around the world, the central banks almost universally dropped interest rates around the world to sort of offer stimulus, right? So we had this situation where you had the markets were doing okay, and then you had the pandemic hit us, and we started entering into a period of decline as tons of unemployment came into factor, which also led to massive slowing in GDP growth, which ultimately led to a loosening monetary policy and ultimately interest rates being cut. Now, I know that that's a lot of things at once, and this is meant to be sort of an introductory video, but I know that this concept is a lot for the new traders. So I'm trying to go through concepts as best I can. The best way I would say is just to dive into this stuff and really just learn as much as you can about it. It is stuff that, you can probably get in an economics class and things like that, but I'm trying my best just to explain it the best I can. But anyways, this idea of a slowing economy, right? A struggling economy that needs stimulus may cause central banks to discuss the idea of cutting interest rates, right? You've heard maybe rate hikes and rate cuts. Well, rate cuts are usually in response to a slowing economy. And so we have seen a lot of that from 2020 onwards. Now we're sort of in a situation here where central banks are racing to do the opposite. Central banks are looking to try and raise rates. They're trying to come back and recover because, things have looked better. Things have recovered from the economy. People are going back to work. Employment is back on the rise. And then that leads to a growth in GDP, which ultimately, like I said, leads to central banks looking to tighten their policy and ultimately perhaps raise or raise interest rates, right? So those are all different factors at play. They all sort of talk to each other. Now, there is another one that I'm missing here off this list. You may be familiar. If you're somewhat familiar with what I'm saying here, I'm going to add it to the top because I'm running out of space. You have inflation. Okay, now this is a huge one, especially in the US, where recently the CPI numbers came out at 5.5% inflation. What that tells us is that inflation is quite high here. Now, what does inflation tell us for the value of a currency? Well, the general idea is that if you have high inflation, they're printing a lot of the money of that currency, and it could cause the devaluing of the US dollar or whatever currency that we're looking at, right? So multiple different central banks report their inflationary numbers to give investors an idea as to what inflation is looking like in that country. Now, inflation is sort of a tricky one because inflationary numbers, when they come out, if you have high inflation reported, what that often means is actually something really weird. When inflation numbers come out high, it usually is viewed as bullish for the currency. But you might say, well, Nick, that sounds weird. You would think that inflation high means that they're printing a lot of that currency and it should go down, right? Well, that kind of is a concern. But the thing here is, if you have high inflation, the usual response from many central banks is high inflation needs to be fought with potentially raising interest rates and tightening monetary policy. Inflation usually occurs from employment being high, salaries being raised, consumer demand being high, lots of people using, products and services out there. Ultimately, just a growing economy. A lot of times we see a healthy level of rising inflation. However, when that gets out of hand, central banks like to cut back on stimulus and generally will be seen raising rates. So that is why a signal of higher inflation oftentimes does receive positive sentiment and may even lead to monetary policy tightening and maybe even talking about raising interest rates. So there's a lot that I've said here, and I want to encourage you really quick. If you're watching this video and you're like, wow, this is a lot of stuff, I encourage you to maybe save this to one of your, playlists or something, and you can come back and watch this if you would like. Now, I do want to say one more thing. So I'm going to clear the board. I'm going to talk about something here. So I want to talk about policy, okay? So we just discussed a whole bunch of stuff, but there are two main tools that come into play when we talk about policy. Now, we've really been talking about these two things, especially recently. The first one is going to be the interest rate that we just discussed, okay? So these are tools available to the central banks around the world to sort of deal with inflationary pressures, to deal with a rising or weakening economy. The first one is going to be interest rates, right? So they have the availability to raise or cut or hold interest rates. This tells us a lot about these central banks around the world. So we'll dive into that in just a second. I want to put up on the second one on the board, however, that there is also the idea of tapering / this idea of stimulus / quantitative easing. Okay, I'm not going to write all that out, but you guys hopefully get the point. So tapering, stimulus, quantitative easing, what is this? Well, before I discuss interest rates, this idea is the idea of stimulus. Have you ever heard of the idea of the Fed buying up stocks and bonds and things to sort of prop up the economy? It's been a big theme here in the last year or so with the Fed in the United States. We had a record amount of stimulus basically launched into the economy to keep things going smoothly, right? So a central bank has this option. A lot of times they print a ton of money, they buy their own bonds, they sort of pump money into the system to hopefully stimulate the economy enough to get it back on its feet. And that's sort of what they've been trying to do here in the US and truthfully in many places around the world. Most of the central banks are doing this. Now, recently, it's been a race to sort of who can start to hold off on the stimulus as much as possible. Because remember, lots of stimulus can result in higher inflation. Higher inflation is not necessarily a good thing. It's actually really hurtful to an economy. Or hurtful to the consumers in an economy. If your currency gets devalued too much, the consumer has less strength to their product, and it makes it harder for them to buy or import goods from other countries. there's a lot here, you guys. I know I'm going through a million factors. So again, feel free to rewind the video if you need to, but let's talk about interest rates. So again, I mentioned that interest rates are a tool available to central banks. They can raise rates, they can decrease rates or cut rates, and they can hold rates where they're at. The thing that we want to talk about, let's talk about this first variable first. Why would a central bank want to raise rates? Well, they may want to raise rates in response to high inflation, a growing economy, and to sort of combat a economy that is sort of overheating, if you will. There is a healthy level of growth in an economy. Something that is too fast could actually be dangerous because you can have it crash really dangerously, and that can be really, really bad, right? So the Fed and most central banks, they want a healthy, solid level of growth in an economy. Not too fast, not too slow. So if it is getting too fast, if it's getting out of hand, the Fed or the central bank that we're talking about, whether it's the US, the Canada, wherever, they may choose to actually rate hike to sort of slow that growth. We have seen that in the past. We have not seen it in a while, but we have seen that in the past. Leading up to the pandemic, we were actually raising rates in the US here. So that can be a response to a rapidly growing economy. So that is often a tool that they will use. When this happens, usually we see a slowdown in equities. We see a jump in the US dollar as people sort of move into cash in response to this a lot of times, as well as the strength and confidence in the US dollar tends to rise. And remember, a higher interest rate is like that dividend effect and attracts foreign investors to the dollar, right? Now, the next scenario we're going to talk about is going to have to be the opposite, cutting rates. Why might a central bank cut rates? Well, generally, one of the main reasons that a central bank would cut rates would be if things are going not so good for an economy. Things are slowing down and not going too hot. Cutting rates, what that does is it makes it easier for businesses to actually borrow money. Cheaper rates basically make it easier for for companies to borrow money. And ultimately, the idea here is that could lead to higher employment. It could lead to all sorts of good things for that economy to sort of stimulate it back into a healthy growth, right? So that is pretty obvious. Now, the final one is a little interesting. What about if you have a scenario in which the central bank says, hey, we're just going to hold rates at where we're at? Well, usually what we see in this case is an economy that is rising at a healthy level, and central banks don't really want to do a whole lot about where sort of the interest rate is at. They don't want to raise it. They don't want to cut it. They're happy where things are at. Ideally for the Fed, by the way, this usually looks like, according to them, a 2% inflation per year. Now, what that means is that, again, things are going well, but they're not going too fast. We're not seeing like 3 or 5% inflation. We're not seeing 1% inflation, which would be more closer to even deflation, which is not good, right? These two things they don't want, but that might be good. And so in that case, they might want to hold rates where they're at. Okay, so all of that to say, now let's talk about, again, we'll just recap on this idea here below. So you have monetary policy in terms of interest rates, but also in terms of tapering and stimulus. Now, this is a really interesting topic. Right now in the US, it's a big debate. They're like, hey, we need to cut the spending from the Fed. It's really causing a problem for inflation. And then the inflation or the Fed has been responding with, oh, it's transitory. It's not going to be forever. And it's used to help keep things in the economy steamrolling back, right? So there's an argument and a conversation constantly from people all over the government as well as, the Fed about this concept of tapering and stimulus going on from the Fed. So that can be a really controversial and interesting subject in markets as well. If tapering does not happen for a very long time, it can be very bad. We've heard the Fed be very stubborn recently. In fact, that's why we kind of see the dip in the dollar recently. We've heard from the Fed that inflation is likely to still be a problem for a while. It is transitory according to them, meaning that they don't expect it forever. But the idea is that we are seeing inflation, and they are also unwilling and sort of stubborn on the idea of tapering or reducing stimulus, reducing quantitative easing, right? They're not willing to step away from that. So what that does is it could lead to further inflation or the devaluation of the US dollar. All those things to say, those are tools and an overview of fundamental analysis for traders. There are more things in the toolbox to add. I do plan on doing more videos in the future. So what I do want to say is that if you made it to the end of the video, thank you very much for being here. Actually, if you made it to the end of the video, do me a big favor and comment down below in the comment section and just let me know that you made it to the end of the video. Just say, hey, I made it to the end of the video. It would mean a lot to me, and I'll try and heart your comment. And with that said, guys, I hope this was helpful to you. If you have any questions, feel free to ask them down below. But I do plan on doing more concepts and more trading tips and educational stuff for free. So again, make sure to hit that subscribe button, like the video. And with that said, guys, we'll see you back in the next one.